Good morning and welcome to today's webcast, 2025 End-of-Year Tax Update for Not-for-Profit Organizations. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And as we get started, I wanted to highlight that Baker Tilly and Moss Adams have joined forces to create something greater. One firm with the resources, expertise, and vision to better serve the middle market. To learn how we're unlocking opportunities for businesses, please visit our website via the link in the slide deck and handouts widget. This is more than a merger, it's a multiplier. And with that, I am pleased to introduce today's presenters, Mary Antonetti, Principal, Emina Cresswell, Senior Manager, and Chi-Wen Liang, Senior Tax Manager. And with that, I will turn it over to Emina to get us started.
Wonderful. Thank you, Emily, and good morning to everyone. Afternoon for some of you. Let's kick things off. So we've got a packed agenda. We're covering IRS audit activity, IRS priority guidance plans, state of the IRS, of course, the One Big Beautiful Bill Act, and then the state of the states. So a packed agenda today. Let's kick things off with what is happening with the IRS and what are we seeing with regards to audit activities. So some focus areas that the IRS is focusing on for tax exempts. As we all know, tax exempts generally do not pay income tax on their exempt purpose activities. However, there are certain ways that the IRS does collect taxes from tax exempt organizations. Those include payroll taxes. And the primary focus on this first bullet point is payroll taxes and worker classification. So worker classification is what they're looking at is whether or not organizations are properly classifying independent contractors as independent contractors instead of employees and vice versa. So it's really checking and double checking to ensure that they are classifying things correctly. If they need to be paying payroll tax, if they have those control factors to be considered employees, then they expect the employer, the tax-exempt organization, to pay those payroll taxes. They're also looking at fringe benefits to see whether or not you are properly excluding them from taxable income and if they should be taxable instead. Another area and focus area is also unrelated business income tax. That is when you have revenue streams that, as a tax-exempt organization, you're receiving that might be unrelated to your exempt purpose. Now, this topic, we could cover an entire hour with regards to unrelated business income tax because there are a lot of caveats, nuances, and a much deeper dive can be done on this topic. Another item that they are also looking at is improper Form 990N filings. So those are those forms where an organization has $50,000 or less of gross receipts during the year. So those really, really small organizations. And what is happening, the IRS is essentially looking at other informational filings that these organizations may be either filing themselves or receiving. And they are having, they're kind of matching the data now to see, you had paid someone in excess of $50,000. Well, how are you able to afford that if you're a small organization and have only gross receipts of $50,000? This is just, kind of a quick, simple example. But what they're doing is they're noticing these organizations are filing these smaller returns that they may be ineligible for. Another way that they're also focusing on is this excise tax on excess compensation. So we were blessed as tax-exempt organizations with this new tax that came about as part of the Tax Cuts and Jobs Act, whereby essentially an excise tax on excess compensation, if someone is receiving remuneration in excess of $1 million, the employer, so the tax-exempt organization or applicable organization, is the one who pays 21% tax on that excess. There's also a golden parachute type payment too that is part of that IRC 4960 code section. That is a new code section as part of that Tax Cuts and Jobs Act. So the excise taxes on those and collecting on the excess compensation. They also have been heavily focused on tax-exempt hospitals. That's always kind of been the case for many, many years, where they're looking at how are they operating under the proper regulations? Are they doing enough charity care to essentially still prove that they are tax-exempt, nonprofit status? This other one, this last bullet point, that's a new one, kind of coming about with regards to some court cases that's been happening within the higher education space, where a lot of organizations and individuals are starting up collectives, so name, image, and likeness collectives. And the IRS generally views those not favorable as being a tax-exempt purpose, because a lot of those name, image, and likeness situations are for the benefit of specific students or specific individuals and not kind of the greater good. Now, we've seen a lot of back and forth here, but they're very, very focused on those types of organizations that are starting up and forming and denying several of those when they are applying for tax-exempt status. So a few focus areas within the IRS, all ways to ensure that the public is still getting the greater benefit and the greater good, and that tax-exempt organizations are staying compliant with their tax-exempt focus. So with that, I believe we have our first polling question. So first one out of 4. So Emily, I'm going to turn it over to you.
Great, thank you. Our first polling question: if you file 990N, what should you keep in your records? Your options are A, public support test, B, support for revenue numbers, C, nothing, D, A and B. And I'll give everyone a few moments to respond. To participate in our polls today, please click your answer and hit submit. Just a few more seconds on this first polling question. All right, let's go ahead and take a look at the results. Emina, back to you.
All right. Great job, everyone. For the most part, A and B, yeah, public support tests and the support for revenue numbers. That's really how you determine whether or not you qualify still as a public charity, and then also the support for revenue numbers is really your support. How much gross receipts did you get during the year to support that you still file and qualify under the average $50,000 threshold. So great job, everyone. All right, so kind of switching gears a little bit here, and some tips for dealing with the IRS. As we all know, the IRS has kind of been on an interesting road this year, to say the least. And so we are seeing notices, we are seeing audits, we're seeing different types of activities happening, and we figured, hey, let's kind of talk about some tips for dealing with the IRS in case you are getting letters, notices, any sort of requests from them, and how to kind of navigate some of these issues. So when you do get a notice, it's really, really important that you respond timely. So usually what you get is in the notice letter, they indicate a date that they need a response by. Sometimes they have a specific agent that you can contact. Sometimes they don't. It kind of depends on the letter. So do make sure that you timely respond, provide the documents that they're requesting, complete. If you are providing things through mail, make sure it is certified mail, because that's really kind of your proof, your best proof that you can indicate this was timely filed and timely submitted. A lot of the time they're also adding fax numbers, so if you're faxing, make sure you document the timely fax, the date, that it went through okay, really any information that you can get from your faxing system, retain it in your documents. You can also call them and request a hold on your account. So let's say they're asking that you have additional taxes owed, and you want to look into things more, but you need more time. You can always call their direct number and request a hold on the account. Usually the agents are pretty good about allowing up to a certain amount of days for you to look at. Typically 30 days is kind of what they allow. Sometimes they can do more depending on the situation and the issue, but generally it's 30 days. Another option, but when you do call and put a hold on the account, it's just a hold on additional notices. So what they can do is they will then, after that 30 days is over, they will continue sending those notices and requesting the money due. So another option is to consider paying the penalty or the tax and then requesting a refund via Form 843 if you do owe. And as part of the Form 843, what you can do is there's a section where you can provide your support, cite the case law, and write a reasonable cause letter to explain kind of what transpired, what happened, especially if there's a situation with payments and the IRS is not showing payments, but you've actually made those payments. Set up the online account, the EFTPS system. That's a great way. That's really kind of where the IRS is headed with pretty much most of their payments these days. They're not allowing checks anymore. The EFTPS system does take quite a bit of time to actually set up, because you have to first set up and then they mail you a PIN that usually takes 7 to 10 business days to arrive. So the sooner you set it up, the better. And then that way you can log into that account. It'll track all of your payments. It'll show the history. It'll have a direct withdrawal number that you can then provide to the IRS indicating, hey, we made this payment. Here's the documentation. I can see it was withdrawn from my account. But the IRS is just, for some reason or another, not applying those payments correctly to your accounts. So we're seeing a few of those issues happening. If you do have an IRS agent, do show up to your office or want to do an in-person meeting, which those are becoming more rare and rare. But if you do have them come in and want to check things out at your location, make sure you put them in a specific seating away from other people. I always say kind of stuff them in the closet, but not really. Let's not do that. They're still people. But essentially, you want to put them away in a location where they can't interact too much with individuals within your office. Another great thing that we do and we tend to do with clients is offer the agent to come to our location, to our offices, and we set them up in a conference room or an office area where they can then work and conduct their audits, and we're available to answer questions. Biggest key here is have contemporaneous documentation. It's really, really important to have contemporaneous documentation as you go. Have things like if you have a card that you pay on behalf of employees and you let them use it and they need to document their mileage, their personal versus business mileage, having that information contemporaneous is really a great way to document, okay, well, this is the percentage that's used for business and this is the percentage that's used for personal use, and this is how we tax that. Documenting your tax positions taken, kind of going back to the unrelated business income slide that I covered earlier, having documentation as to whether or not something is a taxable position, having documentation with regards to your fringe benefits. This is the position we've taken. Having that documentation in place in case of audits will help you showcase, hey, here's our position, here's the code sections, here's all these things that we've accounted for or considered. So that way you're not scrambling towards the end as you're having the audit to then document those positions and substantiate them. Document retention, destruction policy. It is a question on the Form 990. Do you have that policy in place? Having that policy in place is really helpful so that you can have the documentation, the retention items that you need to retain on a permanent basis, like your tax returns, for example. There's certain things that the IRS expects you to have permanently, and there's certain things that you can kind of shred after a few years. So having that policy in place helps organizations maintain the documents that are needed in case of IRS audits. And then kind of a shameless plug here, consult your tax advisor. We have a lot of experience dealing with the IRS, the proper channels. We've got an entire IRS controversy group that just deals here. They've been agents on their side. They're working here with us right now. So we've got a lot of great folks who are able to help you kind of navigate some of these notices, some of these issues, and through the proper channels. All right, so common notices that we're seeing. The IRS has no records of required annual tax returns, even though they're electronically filed. We're seeing quite a few of those for some reason or another, even though they are electronically filed and submitted. So what you do is you just respond to the notice, you indicate the date that you filed, provide a copy of that e-file acceptance. It says, here you go, here is the acceptance, you said you received it. The IRS acceptance, the e-file acceptance, really just means it's been received. It doesn't necessarily actually mean that they accept and approve the tax return, it just means they received it. So it's just kind of a heads up there. Form 990Ns, kind of going back to those small tax filers, late filing reminders. So if they're not filing by their due dates, they'll get a letter saying, hey, we haven't received it yet, make sure you file it on time. Some other ones we're seeing is missing or incomplete schedules, incorrectly reporting revenues, expenses, missing signatures, using the wrong version of the Form 990N. So if they didn't qualify for a Form 990 EZ, for example, because there's different tiers of 990N filings, the N, the EZ, and then the full Form 990. So if you didn't qualify for the EZ, for example, if you had too much gross receipts, what they can say is, hey, you should have really filed this bigger Form 990. As I mentioned, we're also seeing quite a few erroneous notices correctly indicating that the return hasn't been filed. Missing payments, both federal and state side, is what we're seeing too. So responding, having that documentation, that proof, those bank statements, those EFTPS confirmations is really, really helpful here in responding to those erroneous notices. We're not sure what's happening. The IRS isn't sure what's happening either. So they, after several months, even a year later, they are acknowledging, hey, we realize we have been sending folks and taxpayers these notices, these erroneous notices, when in fact we do have their payments. We're also seeing the IRS issuing refunds when the overpayments were requested to be applied to the next year. So the 990Ps, for example, those that file those types of tax returns, this is to report your unrelated business income tax activity. What we're seeing is the IRS is just issuing a refund. It's like, no, we asked you to apply it, please apply it. So a lot of the time what we recommend is just don't cash the check. write them a letter, send it back to the address that you received it from. Usually that's the address on top of the actual check itself. Write a letter and indicate, we're not accepting this check. Please apply it to XYZ tax year and or this tax form, to essentially guide the IRS to what they should have really done in the first place. So kind of a few glitches happening within their systems that are not ideal and just take a lot of taxpayers' time and effort to deal with. So some other things that are happening in a lot of activities, just I would say more so this year than ever, is just scrutiny of activities that tax-exempt organizations are doing with regards to some of those federal directives to identify nonprofits linked to terrorism and alleged political violence organizations, heightened review of political advocacy and cross-border activities. Now, tax-exempt organizations do report their political advocacy and cross-border activities on various schedules of the Form 990, Schedule C, Schedule F. In particular, that's kind of where you highlight, here's what we've done during the year, here's the advocacy, here's the lobbying activities that we've done. It's just getting a little bit more scrutinized. And then, of course, we've got the legality doctrine, when illegal activity can result of loss of tax exemptions, and then the public policy doctrine, which essentially says that these activities are conflicting with the fundamental public policy and could jeopardize the tax exempt status of your organization as well. So a few things that are just getting more scrutinized with the current administration. So then let's say the IRS decides to revoke your tax-exempt status, and this is kind of their typical due process. So what happens is, if they do decide to look into your organization, first step is what they'll always do is an audit or an examination. So they send you a letter saying, hey, we're looking at XYZ activities. Please provide all this information that we'd like to look into. They look at your information. They come up with a proposed adverse determination adjustment. They usually have an adjustment letter. There's conversation happening between the taxpayer, and then if you have your CPA tax advisor involved, usually we're involved in those conversations too. They issue a proposed adverse determination. Essentially, that means, hey, we think you should lose your tax exempt status because you've done activities that don't conform to what your exempt purpose is within our systems. You can then do an appeals review. And if that, again, kind of turns out and says, no, they can do a final revocation. You do have the option to petition and litigate, of course, too. So it's kind of a process. It's a long process that exists in order to lose your tax-exempt status. But there are a few special rules with regards to suspensions for terrorism-related activities that don't kind of follow this path of audit, examination, proposed adverse determination, final revocations, and all that. These particular activities, such as the automatic revocation of missing your tax return filings for the last 3 years. So like if you miss 3 in a row, there is really no appeals. There is no audit or examination. What happens is they just send you a letter saying, hey, you didn't file your tax return for 3 years in a row. We've automatically revoked your exempt status. And then essentially what you have to do is reapply for exemption status within a certain amount of time. There's specific rules and revenue procedures when you do lose your tax exempt status that you would have to then follow to get reinstated as a tax exempt. So that has no appeal. There's really no way to retain it again before then. They say, okay, you're done. So just a few things that the IRS is kind of looking at from a revocation perspective. All right. So with that, we're going to switch gears. Shiwen is going to cover some IRS priority guidance plan items and things that the IRS is focusing on for this next year.
I think we're getting some feedback on Shiwen's line there. Shiwen, are you able to try again here? Okay. Emina or Mary, could you continue on with your portions while we'll see if we can troubleshoot G1's audio connection here?
Hello, can you hear me?
Yes.
Okay.
Thank you.
I'm going to just move forward quickly to the One Big Beautiful Bill so that we can do this part of the presentation, and then we will jump back to C1 once we get that issue resolved. So give me one moment and I will just put forward in the slides. So as many of you all know, while I'm trying to find the slides, as many of you all know that the One Big Beautiful Bill was passed over the summer. Oh, I'm sorry. I didn't flip. Oh, there it is. Perfect. The One Big Beautiful Bill was passed over the summer. It was passed by the House of Representatives as H.R. 1 on May 22nd, 2025. The Senate took up the bill and passed the bill on July 1st, 2025. The House approved the Senate's version on July 3rd, 2025, and President Trump signed it into law on July 4th of 2025. The bill was passed through a reconciliation process, so most of what has to be done is a scoring so that it will stay revenue neutral over a period of time. What was not in the bill that affected not-for-profit organizations? Let's all give a big sigh of relief to parking, because that was a nightmare for everybody else who had to deal with that one in the past from the tax-exempt organizations. The parking provisions were not in there, the name and logo royalty provisions, the research income, the certain provisions impacting private foundations, including the net investment income tax and excise business tax holdings, and sort of what was referred to earlier about 501p and the modifications relating to the termination of tax-exempt status for terrorist supporting organizations. Those provisions were not all included in the bill. There was some slight modifications to the employee retention tax credit. So for claims filed after January of 24, the IRS is not going to process those claims. And there was an extension of the statute of limitations for the third quarter of 2021. So many of you out there, I know, are still kind of stuck in this odd limbo with the employee retention tax credit. And that specific quarter seems to be really more trapped up than other quarters. I encourage everyone to be patient with the ERTC. I know we're going to touch on it again. Would have been earlier, but again later. But, you know, I've seen a lot of different appeals going through and letters that we're writing and hold up by the IRS. And so it is just a slow process. Two of the biggest revenue raiser items that impacted the not-for-profit community is the excise tax on excess compensation and the excise tax on colleges and universities. Neither one of these taxes are new taxes, but they were changed. And the change to the taxes, the excise tax on compensation is estimated to increase revenue by $3.8 billion over 10 years. Though controversial, the excise tax on colleges and universities, and I don't want to belittle $761 million over 10 years, but as you can see, it's actually a much smaller number for the excise tax on colleges and universities. So speaking about excess compensation, I think there's a few things we want to just discuss here. First is the remuneration. When do you qualify? So it's for remuneration paid of more than $1 million and excess parachute payments to covered employees. I always like to once again remind you of excess parachute payments, because this is something that can fall off people's radars. You don't have to hit the $1 million threshold to be subject to the excise tax if you have an excess parachute payment. And what is an excess parachute payment? An excess parachute payment would be any payment to or for the benefit of covered employees in the nature of compensation that's contingent on separation from employment, and the aggregate present value is greater than or equal to 3 times the base amount. So if somebody's base amount is $100,000 and their parachute payment is $5,000, they're going to be subject to the excise tax on the excess even though you're under the $1 million. That has not changed, but it's just something I continually like to remind people. So what has changed? Well, under old law, a covered employee is any employee or former employee of any applicable tax-exempt organization or predecessor that was employed during any taxable year after December 31st, 2016. So basically, you would look through and you would say, who are these? Oh, I'm sorry, that's the new law. The old law was 5 highest employees of the tax-exempt organization in the current or prior year beginning after 2016. So they've expanded it out. So under the old law, you would always look to those top 5 every year. If you had more than 5 people over $1 million, you didn't worry about it. You only worried about the top 5. And then you kept a cumulative list of all the individuals over time that would have been on the list, because once a covered employee, always covered employees, and then you include this. Now, that's sort of thrown out the window, and if you're making over $1 million, you're getting counted. So it's a much broader pool for larger organizations that have multiple people being paid over $1 million. The medical service exemption still applies, so that has not changed. Keep in mind that compensation also applies to compensation paid by a related organization. And in this context, a related organization is one that is controlled or is controlled by the applicable tax-exempt organization. It's controlled by persons or a person controlling the applicable tax-exempt organization. Is it supported or supporting organization of the applicable tax-exempt organization? Or in the case of OBBBA, it establishes, maintains, or contributes to the OBBBA. Now we have a polling question.
All right. Our second polling question, and please forgive us for the technical difficulties here. It says it's our third of 4, but we'll go back and hit that second question as well. So thanks everybody for your patience. All right, under the revised provisions of the One Big Beautiful Bill Act for the excise tax on compensation, who is considered a covered employee? And your options are A, the CEO and CFO only, B, the CEO, CFO, and the 5 highest compensated employees for the current year who make over $1 million, C, any individual who is among the 5 highest compensated employees in any prior year beginning after 2017, or D, any employee of the organization with remuneration in excess of $1 million for tax years beginning after 2025. So as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions, and I will let everyone know we still have 2 more polls after this. So just another moment here to make your selection. And actually, while we're waiting, Chi-Wen, were you able to reconnect?
Can you hear me okay now?
It sounds like we're still getting some feedback from Chi-Wen.
Okay.
So we'll go ahead and take a look at the results. And Mary, I'll turn it back to you.
Thank you. So the correct answer is actually, we lose the letters here, D. Any employee of the organization with remuneration in excess of $1 million for tax years beginning after 2025. Actually, it could be a broader base of individuals because, as I said, you could have parachute payments, but that group of people would be subject to the tax. So now we have the increase in tax rate on investment income of colleges and universities. This has also expanded, albeit not quite to the extent that some of the provisions in some of the earlier proposals in the bills had. So I don't know if we should be thankful for the increased tax or not, but basically, under old law, an applicable education institution was one that had at least 500 students. That, in positive, has been increased to at least 3,000 tuition-paying students during the preceding taxable year. So you always look to the preceding taxable year to determine the amount of students. So that was a win. The downside, so we do have that the student adjusted endowment is what you will use to determine the amount of endowment per student. So the total fair value of the institution's assets, other than assets used directly in carrying out the institution's exempt purpose per student, for purposes of determining the institution's total assets, the assets of related organizations are treated as assets of this institution. So once again, it kind of gets to who's a related organization. So a related organization is going to be an organization controlled or controlled by the institution, controlled by one or more persons that also controls the institution, or supported or supporting organizations with respect to the institution. So basically, they've sort of expanded out the definition slightly of the student adjustment endowment, making sure that they're encompassing not just items within the university themselves, because obviously they're trying to make sure that if you're controlling the assets, it's getting included in the number, and people are not just setting up multiple organizations to get through that. The flat rate tax of 1.4% is what has been indexed. And as you can see on this chart, if your endowment value per student is between $500,000 and $750,000, in the final version of the bill, it's a 1.4% rate. If you're between $750,000 to $2 million, it's a 4% rate, and over $2 million, it gets up to an 8% rate. A couple other items to note: federally subsidized royalty income is going to get included in investment income. Royalty proceeds of any patents, copyrights, intellectual properties from which royalties derive that resulted from work done by students or faculty as part of the organization, and an and test, was paid for by federal funds used to develop the research, would be included. The other thing that's also now included is investment income on institutional loans. There are no exclusions for qualified religious institutions in the final bill. That was something that was talked about. It does limit eligibility of students to citizens, permanent residents, or other who are not here temporarily but have an intention of staying. There is an exclusion for state colleges and universities. As I mentioned before, there's two new revenue pieces into the investment income, one being the interest income from student loans, the other royalty income. And then we touched on the other part. Charitable giving. This is also something that's impacting not-for-profit organizations, but slightly in a different way. From a C corporation perspective, there is now a 1% floor on the charitable contribution deduction. So there was always a 10% limit. So a corporation could only give up to 10% of its taxable income, but now there's a 1% floor in addition to that. So basically they lose the 1% and they get to deduct the middle. From an individual charitable deduction limitation point of view, there is a 0.5% floor. So disallowed contributions below the 0.5% floor may be carried forward if the individual hits their max, but most individuals are not necessarily hitting their max giving potential. So basically, with both of those floors, it's going to more significantly impact organizations with large dollar amounts because that bottom is going to go up. It is going to be a big year, I think, before the end of this year, because knowing from a planning perspective with taxable organizations or taxable people are looking to that, and some of these floors have not kicked in until next year, so they can still get a lot of bang from buck from giving. So hopefully with all of your organizations out there, I'm hoping to see that you'll be getting a lot of contributions this year, this last quarter. May be a timing issue, so just kind of beware from a revenue perspective that some of these people may have kind of double paid to get the bang for their buck on their individual or corporate taxes this year, and it may slow down next year, but still positive. One thing that is very positive is the individual charitable contribution for non-itemizers. So they've permanently created the charitable deduction of $2,000 for joint filers and $1,000 for other filers above the line. So even if somebody's taking the standard deduction, those $2,000 or $1,000 would be deductible. And I think that's going to be a pretty big selling point for a lot of the smaller donations. And then the estate and gift exemption has been permanently increased, the estate and gift exemption. Now the scholarship credit. So Section 25F was put into the bill, and this is something that we've been getting a lot of questions relating to. So if you are giving money to a scholarship granting organization, there is a possibility of a non-refundable tax credit of up to $1,700 for individuals making these contributions. The scholarships have to be for qualifying elementary and secondary school students, and to qualify, the students must have family income at or below 300% of the area's median gross income and be eligible to enroll in a public elementary or secondary school. Just because we're living in the nonprofit world, a quick reminder that a credit is better than a deduction because a credit is going to reduce tax, whereas a deduction is going to reduce the income that is then subject to tax. So this is a very good provision from that respect, where people would want to be able to give money to organizations that qualify in this respect. It is a non-refundable credit, meaning the individual is not going to get the money back because they haven't paid in the money into the system. So the rules, there are a lot of rules. We've gotten a lot of questions on this because a lot of organizations give out scholarships. So they're saying, hey, can we qualify for this? Because, obviously you get the revenue, it'd be a positive thing. There are a lot of rules, and there will be more rules to come. So a qualified contribution is a cash contribution to a scholarship granting organization to fund scholarships for eligible students in the state. The state must have voluntarily elected to participate under Section 25F. The state must have identified the SGO as meeting the requirements of Section 25F for applicable calendar year. There's limitations. The credit can't exceed $1,700. The amount allowed is reduced by, if you're basically in your state, you're allowed to take a deduction. You're not allowed to double dip. So you can't get a charitable deduction for this money that you gave. And if there's a state deduction that you're getting or a state credit, then it's going to reduce the federal credit. A scholarship granting organization is described in 501c3, is exempt from tax and not a private foundation. You have to make sure that it ensures to prevent commingling of qualified contributions with other amounts. It has to be included in the application submitted by the state, and it has to submit the requirements of 25D. Are you getting it here? There's a lot of rules. So Section 25D, I'm not going to go through all the rules, but basically your organization then needs to give 10 or more scholarships to 10 or more students that do not attend the same school. They can't spend less than 90% of the income on scholarships. And then there's other rules about earmarking specific donations to specific students and such. Recently, on November 25th, 2025, Notice 2025-70 was put out. There's a response to that notice, which is due by December 26th of 2025. The IRS has said that they're going to put out temporary regulations relating to this provision, and they're looking to know what they should focus on first. Some of the top things are participating states require annual certification. How are you going to do it? The policies and procedures enacted by states to make sure certification is accurate and complete. Record reporting and record keeping that's going to be required by the SGO, and then other things like organizations that are not in single states or that fundraise and award scholarships across multiple states. If it was supposed to be a single state, how are they going to deal with all these different things? So more to come on this. It is a good provision. I think it's one that spikes a lot of interest, but there's one where more guidance is going to come out. And if it's something that you want to do, you definitely have to reach out to your tax advisor to make sure you're doing it right. It's not as simple as we could tell people they get the credit because we're now giving scholarship money out. It's not that simple. Information reporting, as many of you know, some of the thresholds came. This is things that you're just going to have to comply with. Some of these don't start till 26. Some of them sort of start in 25. So 1099 reporting thresholds increased to 2,000. That's positive. There's just less 1099 reporting. That's going to be in 2026. Employees can deduct up to $25,000 in qualified tips from taxable income, and they're required to report the amount of qualified and non-qualified tips on the W-2. The interesting thing is W-2s aren't changing for this year. So because the W-2s aren't changing for this year, there's a little bit of a question on the proper reporting. What the IRS has come out with is Notice 2025-62, which is basically granting penalty relief to employers and other payers for tax years 25, relating to new information and reporting requirements for qualified tips and qualified overtime compensation. The penalty relief is giving relief from Section 6721, which is failure to file correct information returns, and 6722, which is failure to furnish correct information to the payee. Overtime premiums. So employees can deduct $12,500 in qualified overtime premiums for the taxable income for the year. Interesting with both of these provisions are deductions on the individual tax return. So as of right now, you're not really changing anything from a withholding perspective from individuals. It is more of a individual responsibility. It's just your responsibility to report to the individuals the amount of money they're going to then need to use to calculate. So it's not as if you would just adjust withholding for these things and not take out the withholding on them, because you don't really know if they're going to qualify or not qualify for the credit. So this is sort of what's going to generate refunds to individuals on the back end, because you're going to withhold based on the whole amount. But I am going to go through this example here. So if an employee earns $20 per hour and works 50 hours a week, they receive 40 hours at their $20 an hour, and they receive 10 hours of overtime at $30 an hour. So the overtime's at the time and a half, which is what takes the $20 to $30. So it's only the $10 per hour premium for the 10 hours, which is going to be deductible to them. So it's basically the amount of the overtime pay that is going to be deductible to them. So I know as you guys are all doing the calculations, you may have some questions. Please reach out to us or to your payroll providers, especially in year one, because not everything has kind of been set yet. Now, the next question, which is question 4, but it's really question 3.
Yes, exactly. What must a tax-exempt organization do to comply starting January 2025? To comply with OBBBA's overtime premium reporting requirements, organizations must: A, report overtime premiums separately on Form W-2 and maintain detailed payroll records. B, for 2025, Forms W-2, 1099, and 941 remain unchanged. Employers should follow current reporting rules, but are encouraged to give employees the info needed to claim the qualified overtime deduction, such as a separate accounting of overtime pay. C, eliminate overtime premiums and replace with flat bonuses. Or D, file a separate IRS form for overtime premiums. And we'll also use this time to do another audio check from Shiwen.
Can you hear me now?
We can.
Yes.
Excellent. So we'll wrap up this polling question, and then we will be going back to our second polling question. Thanks, everyone, for your patience. And we'll give everyone another second here. All right, let's go ahead and take a look at the results. And then go ahead.
More information will probably come out on what you're supposed to do, but it is true the forms have remained unchanged. There's some theories about how you're going to report this year, so more guidance will come before the forms are not going to change, but you should still try to provide the information, and we can give more guidance on how to do that.
Great.
Shiwen, I'm going to turn it over to you.
Yep.
Thank you, Mary. So every year, the Treasury and IRS publish a priority guidance plan. This is the roadmap for new regulations, interpretations, and administrative guidance for the next year. It identifies the areas where they intend to spend their time and resources. So the 2025 to 2026 plan focuses on 5 key policy areas that drive their agenda. 1 is the implementation of the One Big Beautiful Bill Act. 2 is the regulation and burden reduction. 3, tribal tax issues. 4, digital assets, and 5 is Secure 2.0. Of the 105 projects that's in the plan, we'll go over 9 projects that specifically impact exempt organizations. The first 2 projects on the left-hand column fall under the One Big Beautiful Bill Act implementation. The IRS will be working on 4968 regulations for the excise tax on endowment net investment income for private colleges and universities. Mary covered a lot of those changes that came from the One Big Beautiful Bill Act, so I'm not going to go over that, but we're going to expect to see some of those changes in the guidance and the regulations. And then the next item is the 4960 guidance on the excise tax for excess compensation above $1 million and excess parachute payments. As Mary mentioned, there's an expanded definition of covered employees, so that upcoming guidance will broaden that scope and how organizations design their deferred compensation, severance, and bonus structures to mitigate the tax. We'll see more of that coming out as well. Now, the remaining 3 projects on the slide fall under deregulation and burden reduction. The IRS plans to simplify compliance to reduce the unnecessary reporting in these areas. We're going to see public inspection and how that's going to change, how exempt organizations make their exempt application, Form 990, and other materials are available. Private foundations can also look forward to updated guidance on expenditure responsibility. This applies when foundations make certain types of grants, particularly to foreign grantees or to non-public charities. And the last one, it's a big one, is the donor advised funds. This is the Section 4966 final regulations for excise taxes on sponsoring organizations and fund management for impermissible taxable distributions from DAF. The proposed regulations were issued back in November of 2023, and since then it's raised many questions and drew a large number of comments and even a public hearing. So we expect these long-awaited final regs to clarify taxable distributions and the definitions that were related to DAF introduced in the proposed regs. The IRS is also updating its guidance on how private schools demonstrate compliance with the fundamental public policy against racial discrimination. In light of the recent Students for Fair Admissions court case, in that 2023 Supreme Court ruling, the court held that race-based affirmative action in college admissions practices violated the Equal Protections Clause. So it appears the IRS will revisit that guidance in the Revenue Procedure 7550 to clarify how the schools should implement affirmative action policies going forward. They're also working on guidance related to the Johnson Amendment, and that's a prohibition on political campaign activity by 501c3 organizations. In a pending court case right now, the IRS and several churches have asked the federal court to approve a settlement that would prevent enforcement of the Johnson Amendment against those churches when they discussed electoral issues during religious services. They are arguing that good faith religious teaching on political topics is not campaign intervention and that restricting it would violate constitutional rights. While any of these rulings would apply only to those plaintiff churches, this signals a possible shift in how the IRS may approach political activity rules for religious organizations going forward. And the last 2 remaining projects on this right-hand column relates to updates on administrative procedures to clarify which jurisdictions will issue the termination letters and letter rulings related to employee plans and exempt organizations. Now, what's notable this year is that several projects have appeared consistently in prior years were removed from the list. Don't take these submissions to mean that the IRS is no longer interested in these projects. Some of them were removed because they didn't really belong to those 5 key focus areas, but they may be added in the future priority guidance plan. So for example, the guidance for group exemption letters, hospital compliance guidance under 501R, the expense allocation rules for unrelated business income, and then also the self-dealing rules in private foundation invest in a partnership where a disqualified person is also a partner. The last three projects are the DAF guidance projects that were initially introduced in 2023 and the 2024 plan. So we're hoping to see this added back in a future plan. I think now we have our next polling question, so I'll turn it over to Emily.
All right. And this is, although it says our second polling question, our fourth and final. Which one of these priority plan guidance items did you hope would be addressed this year? And your options are A, DAFs, B, UBI expense allocation, C, group exemptions, or D, 501R hospital guidance. And once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window. We'll give everybody a few moments to respond on our final polling question for today. All right, let's go ahead and take a look at the results. And Emina, I believe I'm passing it over to you.
Yep, thank you. Yes, I agree with the results. I was kind of hoping some UBI expense allocation rules as well, but they've been dropped. So we'll see when that pops up again. So with that, I'm going to just quickly cover state of the IRS. Where are they at right now? What's the year look like? As we all know, there have been reduction in the workforce, about 25% based upon these figures here. 25,000 were deferred resignations, retirements, or other separations. 294 people were just reduction in workforce, and then estimated 77,000 remain. So, kind of big picture, that's where the IRS is at. Further breakdown here, what you can see is business units and about 25% reduction in the tax-exempt governmental entities. So a small but mighty group with about 569 employees being laid off with regards to these workforce reductions. So pretty significant percent. If you think about it, 25% is substantial. Jobs, you can see here, revenue agents, tax examiners, management and program analysis with the most notable percentage changes of separations, revenue agents, tax examiners. I've been monitoring the Q&As and I see some frustrations with regards to getting answers, contact representatives. This is probably why you're experiencing some frustration and some issues. You may have started an audit and the agent is no longer there, so you can't ask them those questions. Appeals are being closed. Exams are being closed pretty quickly without a lot of explanation. So that's kind of part of what's happening is I'm sure it's frustrating, but there are taxpayer advocate services that you can utilize to help you contact and get some further clarifications. We had the IRS government shutdown. Everything was paused, tax-exempt applications processing, cancellation in-person assistance and appointments. Be patient is all that we can say at this point in time. Expect processing delays. It's going to be impacted by this government shutdown. They're still trying to do more with less. So have some patience, keep following up, keep calling the numbers that you've been provided to follow up and check in. So with that concludes kind of where we're at with the IRS. We're gonna jump towards the end here and wrap it up with state of the states and kind of what's happening with the states. Shiwen?
Thank you, Emina. So there are some two big trends that we're seeing with the states. On the next slide here, There's a growing number of states that are requiring more charitable solicitation registrations to be made online through state portals. I know that's caused some frustration for those that are new to the portal. There's also decreases in state revenues that's had a trickle-down impact on reduced grant funding at a time when that need is greater. And so we are going to see a lot of that funding go down. And, you want to make sure that you are diversifying your funding streams, looking at, individual charitable giving, private foundation grants, corporate sponsorships, or even fee-for-services to see how you can get more funding and to do more in your community. I know we're just at the end of it, so I think we're just going to go. You can also take a look at these slides. The state of states, California, I'm just going to go over that really quickly. There is a new safeguard in place to protect what's considered a qualified nonprofit organization, to also include a state tax exemption in California. So depending on how you obtain your exemption, whether it's through the long form, Form 3500 or 3500A, you could still retain your California exemption even if the IRS has revoked your tax exemption. And that concludes our presentation for today. Thank you so much to everyone who was able to join us and your patience with the technical difficulties. And I'll hand it back to Emily to close us out.
All right. Thank you, Mary, Emina, and Chi-Wen for a great presentation today. And again, thank you everyone for your patience as we made it through our technical difficulties. We had a lot of questions coming in throughout, and if we didn't have time, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance. Thank you for joining us, and we hope you'll join us again next time.